The live trading price for Opendoor Technologies Inc., traded under the ticker NASDAQ Open, is currently standing at $7.44.9, reflecting a significant intraday gain of approximately 5.90%. This is a powerful move coming right out of the gate on Monday morning, showing a sharp continuation of positive momentum that has characterized the stock's volatile trading over the past few weeks. What is particularly interesting about this specific surge today, beyond the simple percentage gain, is its timing. It arrives just a few short weeks before the company's crucial third quarter 2025 earnings report scheduled for November 6th. This pre-earnings uplift suggests a contingent of investors, both retail and institutional, are not just anticipating a slight beat or a modest guidance revision, but a fundamental improvement in the company's core unit economics, specifically in their contribution margin per home, fueled by optimizing their pricing algorithms and a stabilizing housing market. The market's expectation for Opendoor has long been divided. There are those who see the iBuying model as inherently flawed, essentially a house flipping operation disguised as tech, highly sensitive to interest rate fluctuations and housing cycle shifts. Then there's the counter-narrative, predominantly championed by retail investors and some funds, who believe that with the recent changes in leadership, specifically the return of co-founder Eric Wu to the board and the appointment of new CEO Kaz Nejiatan, the company can finally execute on its data-driven model and achieve scale-based profitability, especially if the Federal Reserve signals a softer stance on rates later this year. The reality of today's price action strongly leans into the latter, but the foundational question remains: is this a sustained recovery based on business fundamentals, or simply another speculative spike fueled by short-term trading dynamics? Looking closer at the recent stock movement, the sheer volatility of OPN shares is a defining feature. Its 52-week range spans from a low of about $0.51 to a high of $10.87, a range that underscores the extreme swings the stock is capable of. This current jump is taking the price close to its recent high, creating a technical battleground new to $7.50 level. The average daily volume for the stock is massive, a reflection of both high retail interest and significant short-selling activity, which we will discuss shortly. This elevated trading volume translates directly into rapid price movements, which is why OPN is frequently discussed on retail trading platforms and forums like Reddit. They view the stock as a prime vehicle for quick swings, often amplifying market news, whether good or bad. For example, the news that trading firm Jane Street Group recently disclosed a passive stake of nearly 6% in the company was a significant catalyst that drove buying pressure. On the flip side, the public comments from known short sellers, including controversial figures like Martin Shkreli, who openly stated his short position, contribute to the high-stakes, polarized trading environment. The real story here isn't just the price going up, it's the intense, often emotional conflict between long-term optimists and structural skeptics playing out in real-time order books. The Opendoor business model is what makes it so polarizing. At its core, Opendoor is a digital real estate platform that aims to make buying and selling homes radically simple and instant. They do this through iBuying, or instant buying. The company uses proprietary data science and pricing algorithms to give homeowners a cash offer for their house almost immediately. They then purchase the home, perform minor repairs, and resell it. The goal is to profit from the spread between the purchase price, holding costs including interest, and the final sale price, while also collecting service fees. When interest rates were low and the housing market was surging, this model worked well enough to generate immense revenue growth, but at the cost of massive operational losses. When interest rates climbed dramatically, houses sat on their balance sheet longer, holding costs soared, and the risk of mispricing increased exponentially. The market's underlying belief is that the model works only in a perfect housing environment, which rarely exists. The new reality that the company and investors are counting on is that the new management team, specifically CEO Kaz Nejiatan, who comes from a background focused on scale and operational efficiency, will tighten up the algorithms, reduce inventory holding times, and prioritize gross margin per transaction over pure volume. This shift from a growth-at-any-cost structure to one focused on profitable execution is the single most important metric for the stock's long-term survival. Now, let's address the elephant in the room, the extensive short-selling pressure. Opendoor is a heavily shorted stock. As of the most recent settlement date, the short interest stands at an enormous 150.68 million shares. This represents a short interest percentage of the float at over 21%. To put that into perspective, over one-fifth of the freely tradable shares are being bet against by institutions and hedge funds. The days-to-cover ratio, which estimates how many days it would take for all short sellers to buy back their shares, given the average daily volume, is extremely low at less than 1 day, indicating that while the short volume is large, the liquidity is currently high enough to prevent a massive sustained short squeeze on current trading volume alone. But the potential for a gamma or short squeeze is a constant underlying tension, especially with the high volatility volatility and passionate retail interest. Firms are shorting OPN because of their deep-seated skepticism about the iBuying model's sustainability, especially in a non-zero interest rate environment, citing the negative returns on assets and equity and the high debt-to-equity ratio of $3.46. They argue the company's profitability is still far off, with analysts maintaining an average price target of around $1.45, a stark contrast to the current trading price. The short borrow fee rate, though fluctuating, has remained relatively low, around 1.04% recently, which means that the cost for hedge funds to maintain their short positions is not yet prohibitive. For retail investors tracking this stock, the short interest data is not just trivia, it is an actionable insight. You should monitor two things closely: the bi-monthly short interest report published by NASDAQ for changes in the total number of shorted shares and the daily put-call ratio. Currently, the options open interest put-call ratio is around 0.50, which is actually a bullish indicator because it suggests that significantly more traders are holding open call options, bullish bets, than put options, or bearish bets. This high ratio of bullish option positioning, combined with the high short interest, is the perfect recipe for a volatility spike. If a strong earnings report is delivered next month, or if the macroeconomic environment improves, the rush for short sellers to cover their positions could ignite a short squeeze amplified by the existing call options going into the money. Responsible investors should avoid simply chasing the price higher based on squeeze chatter. Instead, use these metrics to gauge sentiment and volatility risk. The fact that the stock is highly volatile, with a 5-year beta of $3.60, means it moves nearly 4 times as much as the overall market, a key factor for risk management. Comment below how many shares of Opendoor, OPN, you currently hold, or what price you think the new CEO needs to hit to prove the business model is working. Do you think Martin Shkreli was right this time in shorting the company, or are his comments simply pushing more fear into an already speculative stock? The institutional activity is also sending mixed signals. While total institutional shares held are high, at over 338 million, major long-term holders like BlackRock and Vanguard reduced their positions significantly in the last reported quarter, signaling a decrease in conviction from some of the biggest players. Conversely, quant funds and smaller managers like Two Sigma Advisors and Cube Research and Technologies have taken massive new or significantly increased positions, suggesting a calculated attempt to play the volatility or bet on a quick recovery. The institutional tug-of-war is precisely why the stock remains so unpredictable. Looking forward, the upcoming catalysts for Opendoor are concentrated and near-term. The most immediate and critical event is the Q3 2025 earnings call scheduled for November 6th. All eyes will be on the company's gross margin and adjusted EBITDA. The market will be looking for clear evidence that the new leadership's focus on profitability, reducing inventory turnover time, and optimizing home acquisition is actually yielding results. A positive result on key margin metrics could validate the recent stock surge and signal a broader turnaround in the company's operational efficiency, moving the focus from whether the model can work to whether the team can execute it. The next few weeks, particularly the November 6th earnings report, will determine if this latest surge is the start of a legitimate financial recovery or simply another temporary high in an exceptionally volatile narrative.